What if I told you that billions of dollars in goods have just disappeared from America's ports, and almost no one is talking about it? April 2025 just became a turning point. A 145% tariff on Chinese imports didn't just shake up trade. It sent shockwaves through the U.S. economy. $14 billion in shipments? Gone. The port of Los Angeles? Looks more like an abandoned movie set. Retail giants are on edge. Smaller businesses are bracing for collapse. And if you think this won't hit your wallet, think again. Let's break down exactly what's happening and what this trade freeze means for the prices you'll see this summer. Los Angeles, the beating heart of America's Pacific trade, is slowing to a crawl. Cargo volumes are expected to crash by 35% compared to last year. Gene Soroka, the executive director of the port, didn't sugarcoat it. This isn't a slowdown. This is a shutdown. Major shipping lines, including Mark and Hapag-Lloyd, are canceling routes, scrapping schedules, or rerouting entirely. In April alone, over 80 sailings to the West Coast were cut. May, even worse. Across the Pacific and China, the story is the same, just in reverse. Export terminals are backed up. Containers sit untouched. Ships are skipping U.S. stops altogether, or floating aimlessly, waiting for clearance that might never come. And this isn't some COVID-era delay caused by safety checks. This is deliberate. This is political. And it's bringing the machinery of global trade to a halt. Dock workers in L.A. are losing hours. Massive cranes, once spinning 24/7, now hang still like rusted relics. Even ports on the Gulf and East Coasts, normally shielded by diverse trade partners, are now overwhelmed. They're juggling rerouted cargo, delayed customs clearances, and chaotic traffic. The Northwest Seaport Alliance reports freight volume down by up to 30%. Some exporters are scrambling to cancel shipments mid-ocean. Half of LA's port traffic historically comes from China. So when that pipeline shuts down, it's not a ripple. It's a tidal wave. Now let's talk about how this hits you. Because what's stuck in a container today might be missing from a store shelf tomorrow. Walmart, Target, Home Depot, they're already hurting. Their lifelines? Chinese imports. And right now, those lifelines are drying up. The National Retail Federation says import volume is set to drop 20% in the second half of 2025. And while the headlines haven't screamed shortage yet, insiders say the clock is ticking. Big retailers typically keep around 5 to 7 weeks of inventory. That buffer is now shrinking fast. Gene Soroka, again, the LA port director, warns that if the standstill continues, we're looking at not just fewer products, but more expensive ones, too. Already, shelves are thinning out. Clothing, electronics, home goods, there's less choice, fewer sizes, and longer waits for restocks. Prices? Holding steady for now. But economists warn, if the tariffs stick, inflation won't just creep in, it'll surge. Small businesses are taking the hardest hits. Jay Foreman, CEO of the toy company Basic Fun, says one missed shipment near the holidays can turn into a disaster. Toys that arrive late don't just collect dust, they become unsellable. And switching suppliers isn't a quick fix. It's expensive. It takes time. And in a fast-moving retail world, delays can be deadly. Even the big guys, the Amazons and Costcos, are having to rethink their entire logistics playbook. They're considering alternate suppliers, even reshoring to the U.S. But none of those options solve the now problem. And make no mistake, this trade war is rewriting everything from how products are stocked to how prices are set. Q3, it's looking like a rough ride. Now, let's look at how this economic standoff is rippling through the rest of the U.S. economy. What started at the ports is now shaking the foundation of the entire U.S. economy. That $14 billion cargo gap, it's not just a shipping statistic, it's a flashing red warning sign. In the first quarter of 2025, U.S. GDP slipped by 0.3%. That's the first economic contraction since the peak of the pandemic. Transportation has been hit like a freight train. Truck routes are drying up. Rail freight is stalling. Logistics firms are downsizing, cutting shifts, and even furloughing employees. If shipping doesn't rebound soon, layoffs will spread fast to warehouses, fulfillment centers, and storefronts. Manufacturers are also feeling the crunch, especially car makers, who rely on Chinese parts for electronics and interiors. As those costs rise, so will the sticker price on your next car, and your washing machine, and maybe even your iPhone. And here's the real kicker. Businesses don't know how long this tariff standoff will last, so they're slamming the brakes. Hiring is being frozen. Factory upgrades and new investments put on hold. Even companies that bounced back strong after COVID are now second-guessing their futures. Confidence is evaporating, and the longer the standoff drags on, the harder it'll be to climb out. Even if tariffs were lifted today, experts say recovery would still take months. Because this isn't just about trade, it's about trust. And right now, the system feels broken. With trade from China nearly paralyzed, U.S. companies are scrambling to find new partners. The big idea? Shift supply chains to Southeast Asia. Vietnam, Thailand, Indonesia, they're the top contenders. But reality is hitting hard. Vietnam's factories are overloaded. Ports are backed up. Skilled labor is stretched thin. Thailand is struggling with quality control as orders pour in faster than it can handle. These countries simply don't have China's decades-long scale and infrastructure. Not yet. For a company to fully switch vendors, to find new factories, meet standards, ship products reliably, it can take 12 to 24 months. And during that time, costs skyrocket. Customs delays, cargo limitations, new compliance headaches. Some companies, especially in tech and automotive, are eyeing something even more ambitious: reshoring, bringing manufacturing back to the U.S. But there's a problem. Labor is expensive. Regulations are strict. And unless you're in a high-margin or automated industry, reshoring might not make financial sense. It sounds good on paper, but in practice, it's tough. For now, many businesses are stuck in limbo, hedging their bets between short-term survival and long-term strategy. All this uncertainty is creating what economists are now calling structural volatility. Retailers don't know how to plan. Manufacturers are burning money to stay flexible. And investors? They're getting skittish. Research budgets are being slashed. Capital spending is down. And instead of innovation, companies are hoarding stock just to avoid the next disruption. Consumers are already feeling the consequences. Electronics, clothes, furniture, fewer options, slower restocks, and creeping price hikes. Labor markets are under pressure too. Warehouses are shortening hours. Companies are delaying hiring. And if this continues, actual job losses are on the table. Meanwhile, the world is watching. If U.S. trade policy seems unstable, countries may start leaning harder toward the EU or Asia-Pacific deals. And that could leave the U.S., once the center of global trade, on the sidelines. Closing thoughts. This isn't just a shipping story. It's a test of America's economic resilience. Ports are quiet. Shells are thinning. Confidence is shaking. And the decisions made in boardrooms in Washington today will shape how and where global business is done tomorrow. So what do you think? Should the U.S. hold firm on tariffs or return to the table with China? Can Southeast Asia realistically take China's place? Or are we setting ourselves up for years of instability? And is reshoring a real solution or just political theater? Let's talk in the comments. Global Pulse is where we figure out the future together. If this helped connect the dots for you, hit subscribe and join the growing community that's tracking the pulse of global change. More deep dives are just one click away. Check out the videos on screen now, and we'll see you in the next one.